So imagine paying top dollar to join this ultra-exclusive, incredibly prestigious country club.
Okay, I'm picturing it.
Right. So you pay the massive initiation fee, you walk through these heavy mahogany doors, and the main clubhouse is just, it's everything you dreamed of. I mean, it's practically printing money.
Oh, absolutely. The margins in those places are incredible.
Exactly. The members basically have no choice but to pay their dues. And the financial mechanics, well, they just run on autopilot. But then you walk out the back door of this pristine clubhouse,
Right.
and you realize the owners have secretly bolted this massive, sweaty, hyper-competitive, low-margin consulting firm right to the back of the property.
Wow. Okay, that's a pivot.
Right. And suddenly you realize your expensive membership dues are, secretly subsidizing this chaotic back office.
That completely changes how you view the property you just bought into. I mean, you thought you were buying a pure luxury monopoly, but you actually bought a very complicated, highly blended piece of real estate.
Which brings us perfectly to the actual corporate equivalent of that bizarre country club.
Yeah.
We are looking at S&P Global, Inc., trading on the New York Stock Exchange under the ticker SPGI.
A giant in the space.
Huge. And to set the exact parameters for you listening right now, we're taking a snapshot of this business as of May 19th, 2026.
Right, today's date.
Yep. The stock is currently trading at roughly $410.40 a share.
Okay.
And that price tag gives this financial giant an equity market value of about $122.1 billion.
I mean, that is just a staggering amount of enterprise value. It places them firmly in the, upper echelons of the global market. They are a true mega cap financial infrastructure player.
Exactly. But our mission today is decidedly not to just marvel at their size or, read their marketing materials back to you.
Yeah.
Okay, let's unpack this. Our mission is to tear this business down to the studs and evaluate whether this $122 billion giant is actually a high-quality investment today.
Right, and we're doing this using a strictly skeptical buy-side framework.
Because when you're looking at deploying capital, you don't just take management's adjusted numbers at face value. You look for the structural reality underneath the story.
You have to.
Yeah.
Because companies at this immense scale, companies that have basically spent a decade buying and selling billion-dollar divisions, they are incredibly skilled at financial framing.
Oh, they're artists at it.
Exactly. They know exactly how to direct your attention to that mahogany clubhouse and away from the messy back office. So our job is to walk the entire property.
Right. And we have to start by tearing down what the broader market actually thinks S&P Global is.
Right.
Because if you read the financial press or, skim the top-level analyst notes, the headline narrative treats them like this seamless, continuously growing software compounder.
Yeah, you see that everywhere.
Right. They're pitched as this tech-adjacent data monopoly that simply mints money.
It's a very seductive story, but it is structurally inaccurate.
Yeah.
S&P Global is not a pure software company. It is fundamentally a hybrid. And the strongest evidence for understanding its long-term quality, which simultaneously exposes its biggest narrative flaw, well, it lies in its segment mix. The business is intensely bifurcated.
So I have the segment numbers from the 2025 financial year right here, and this is where that X-ray starts to show some very weird bone structure.
Let's hear them.
We have two segments that are, frankly, mind-blowing. The ratings division generated roughly $4.7 billion in revenue.
Massive.
And it did that at a massive 64% operating margin.
Wow.
Then you have the indices division.
Yeah.
They generated $1.85 billion in revenue at an even higher 69% operating margin.
We really need to pause and unpack the mechanics of a 69% operating margin. Because that is almost unheard of in traditional commerce.
It's insane.
It means for every dollar of revenue that comes in the door, 69 cents drops straight down as operating profit.
Right.
It indicates a business model that requires virtually zero incremental capital to grow. You don't need to build new factories, you don't need massive supply chains, and you hardly need to hire new engineers to service your next client. It is the definition of an exceptional toll booth.
But then you turn the page in the 10K, and you look at their other major division, market intelligence.
Right, the back office.
Exactly. In 2025, market intelligence produced $4.9 billion in revenue. So to be clear, it's actually the biggest segment by top-line revenue.
Yeah, that's key.
But it only produced a 20% operating margin. It
Ouch.
carries a much heavier competitive intensity, massive sales and marketing overhead, and these enormous amortization costs.
That stark contrast is the central tension of the entire company. You have two highly advantaged, economically beautiful segments, ratings and indices, paired with this massive, heavy segment that operates in a grueling, fiercely competitive enterprise data market.
So we're looking at a financial barbell here. On one side of the barbell, you have pure gold, these absolute toll booths cruising at nearly 70% margins.
Yep.
And on the other side of the barbell, you're lifting heavy iron weights in a crowded, sweaty data market for a 20% margin. So the trillion-dollar question for you as an investor is whether the market is essentially forcing you to pay gold prices for the entire barbell.
And the market absolutely does value the entire franchise, as if that weaker, heavier end of the barbell market intelligence will magically converge upward toward those 70% margins of the core.
Right, they just assume the whole thing gets better.
Exactly. Analysts model out these assumptions where the consulting firm eventually turns into a country club. But the fundamental reality of enterprise data businesses argues for extreme caution against that assumption.
See, I have to push back on that a bit, because if I'm looking at their assets, they literally own the S&P 500 data. They
True.
have a massive scale. So why is market intelligence considered a grueling knife fight? Like, why can't they just bundle their proprietary data and force Wall Street to pay whatever they want, driving those margins up to 50 or 60%?
It's a great question, but it's because the underlying mechanics of how these products are sold and consumed are completely different from their core monopolies. To understand why market intelligence is a knife fight, you first have to understand why ratings and indices are monopolies.
Okay, break that down.
The golden side of the barbell benefits from what we call structural regulatory embedment.
Okay, walk me through exactly how that embedment works mechanically. Take ratings, for example.
Sure. Imagine a massive corporation, let's call them megacorp, and they want to build a new factory and they need to borrow $1 billion to do it. So they decide to issue corporate bonds.
Right.
Now, the people buying those bonds are massive pension funds and insurance companies. Under global banking regulations like the Basel III capital requirements and rules set by the SEC, those pension funds are legally required to hold assets that have an official credit rating from a nationally recognized statistical rating organization, or NRSRO.
And there are only a handful of those in the world, right?
Exactly. S&P, Moody's, and Fitch essentially form an oligopoly. Megacorp cannot legally sell its debt to these massive buyers unless it pays S&P or Moody's for a rating.
So it's basically a tax.
It is a regulatory tax. S&P doesn't have to launch some massive marketing campaign to convince Megacorp to buy a rating. Megacorp's investment bankers will literally beg S&P to take their money so the bond issuance can proceed. That is why the margin is 64%. The customer acquisition cost is practically zero.
That's wild. Okay, so what about indices? How does that 69% margin flywheel actually spin?
Oh, indices might be an even better business than ratings. Think about a retail investor opening a brokerage account and buying a broad S&P 500 ETF from a provider like Vanguard or State Street.
Pretty common scenario.
Very common. S&P Global owns the intellectual property of the S&P 500 index. When Vanguard creates an ETF that tracks that index, they have to pay S&P Global a licensing fee, which is usually a tiny fraction of a percent, a basis point fee on the total assets under management, or AUM, in that fund.
So here's where the math gets incredible. If the stock market naturally appreciates by, say, 8 or 10% in a given year, the assets under management in that ETF automatically go up by 8 or 10%.
Right, and S&P Global's revenue from that ETF goes up by exactly the same amount. They didn't have to hire a single new developer, they didn't have to update any software, and they didn't have to pitch a new client.
Wow.
It is an automatic mathematical flywheel. The bouncer at the country club just checks the size of your wallet every year and takes a percentage forever.
Okay, so those are the gold weights on the barbell. Now contrast that with market intelligence. How does the sale of a market intelligence terminal or, a data feed differ from what you just described?
Well, in market intelligence, you are selling desktop terminals, data feeds, and workflow software to financial analysts, portfolio managers, and investment bankers. There is no regulatory mandate forcing a hedge fund to buy S&P's Capital IQ platform.
Right.
You are fighting for budget every single year against incredibly formidable competitors like Bloomberg, FactSet, and Refinitiv.
And if a hedge fund has a bad year, they can absolutely cancel their Capital IQ subscriptions to save money. I mean, they can't cancel their bond ratings, but they can definitely fire their data vendor.
Precisely. So you have to employ massive global sales teams to constantly pitch new clients. You have to employ armies of engineers to constantly update the user interface and add new data sets just to keep pace with what Bloomberg is
It's
offering.
an arms race.
It is. If you stop innovating for 6 months, your clients churn. So while the sheer breadth of S&P Global helps them cross-sell these products, that breadth does not eliminate product-level competition. You are fighting trench warfare for every dollar of revenue, which is why the margin sits at 20% instead of 70%.
So the barbell is structurally lopsided. You have this beautiful regulatory tax, an AUM flywheel on one side, and grinding enterprise software sales on the other. But even the gold side of the barbell isn't immune to gravity, right? I mean, the market treats the ratings business like it's an unbreakable bond proxy, but parts of this business are highly cyclical.
Oh, very much so. While S&P Global is often celebrated as highly resilient because a large share of its overall revenue is recurring or deeply embedded in workflows, it is absolutely not immune to macroeconomic cycles.
Right.
The golden toll booths only collect tolls when there is traffic on the highway.
And for the ratings division, the traffic on the highway is corporate debt issuance.
Exactly. If we hit an inflationary environment where central banks hike interest rates aggressively, or if credit markets freeze up during a panic, companies simply stop issuing debt.
Makes sense. They just wait.
Right, they delay their refinancing, they cancel their M&A deals, and they wait for better rates. And when debt issuance stops, the transaction revenue in the ratings division plummets immediately. It is highly sensitive to the cost of capital.
Furthermore, the indices flywheel works in both directions. It depends on AUM and equity prices. So if the S&P 500 enters a sustained bear market, or if there's a massive rotation out of passive ETFs, the AUM drops, and those automatic licensing fees shrink proportionally. The bouncer takes a cut of a much smaller wallet.
Exactly. And this vulnerability brings us to a major point of forensic concern regarding their medium-term growth targets. Management has been out there projecting 7 to 9% enterprise organic constant currency growth over the next 3 to 5 years, along with double-digit adjusted earnings per share growth.
Which, sounds fantastic in a press release.
Yeah.
But as a skeptical buy-side analyst, when you read the footnotes on those targets, what are the underlying assumptions holding those numbers up?
Well, those targets explicitly assume historically favorable market conditions. They are banking on historical issuance growth in the global credit markets, and they are banking on historical average S&P 500 equity returns continuing smoothly into the future.
So everything goes perfectly.
Right. They're assuming the highway stays perfectly clear and traffic moves at 70 miles per hour.
So if the macro environment actually shifts, if we hit a real grinding recession, or if interest rates stay restrictively high for longer than the market expects and choke off corporate borrowing, this end of the barbell gets heavy quickly. The 7 to 9% growth target is entirely beholden to the broader financial weather.
It is a cyclical business wrapped in a secular growth narrative.
Okay, so if this business is essentially a barbell of incredibly disparate margins and cyclical vulnerabilities, a country club bolted to a massive consulting firm, how did it actually get built this way? Because companies don't just wake up one morning as $122 billion barbells.
No, they don't.
This architecture was designed. So to understand the current structural reality, we have to look at the blueprints drawn by management over the last decade.
The history of this company is critical for an investor to understand because it reveals what kind of manager the executive team has been. It reveals their fundamental philosophy for value creation. Do they rely on organic innovation, or do they engineer growth through constant, massive acquisitions?
Well, we have to trace the modern era of S&P Global. And the relevant timeline for our deep dive really starts around 2013 under the leadership of then CEO Douglas Peterson. The very first major move in this era was the exit of McGraw-Hill Education.
Which was a massive defining pivot. For a long time, the company was known for educational publishing McGraw-Hill textbooks. Publishing is a capital-intensive, physically constrained business. You have to print heavy books on dead trees, store them in warehouses, ship them across the country, and deal with physical returns.
Sounds like a nightmare compared to data.
It is. So selling that division off to Apollo Global Management was a brilliant stroke of portfolio simplification. It signaled a permanent pivot away from physical media and toward the holy grail of pure, zero marginal cost financial data.
It makes perfect sense. I mean, why print textbooks for a 12% margin when you can sell an index license for a 69% margin? So they clean house. But then in 2015, they execute the acquisition of S&L Financial.
And S&L was a major turning point. S&L Financial was a highly respected provider of deep, sector-specific data for banking, insurance, and real estate. Blowing them gave S&P a much deeper footprint in the workflow tools used by investment bankers.
Okay.
It was a major expansion of their market intelligence capabilities, but crucially, it marked the beginning of an increased reliance on mergers and acquisitions to expand their perimeter. They decided they were going to buy their way into new verticals rather than build the data sets from scratch.
Right. And then in 2016, they make it official. They rebrand from McGraw-Hill Financial to S&P Global, and they sell off J.D. Power. Most of you listening probably know J.D. Power from those car commercials where an automotive brand wins a quality award.
Right, the trophies.
Exactly.
Yeah.
So again, they are pruning a non-core asset to consolidate their identity around their strongest franchise, global financial markets.
And to their credit, this early period was a masterclass in curating a moat. They were actively shedding the assets that diluted their focus. But this addiction to M&A eventually leads them to hunt for bigger and bigger prey.
Which brings us to the whale. In 2022, they completed the transformative IHS Markit merger. This wasn't just a bolt-on acquisition. This was a colossal $44 billion mega merger.
It was one of the largest financial data deals in history. IHS Markit was a massive conglomerate in its own right. It had a huge footprint in fixed income pricing, energy data, and automotive mobility data. The strategic rationale was to create an absolute behemoth of data breadth. They wanted to be the single, indispensable terminal on every financial desk in the world.
But, swallowing a $44 billion company is not like buying a software startup. The reality of that merger brought years of integration headaches. They had to figure out how to merge massive legacy technology stacks. They incurred billions of merger costs, severed thousands of redundancies, and most importantly, they brought a staggering amount of goodwill and amortization onto their balance sheet.
Yeah, they bought growth, but they paid a massive premium to get it.
Exactly.
And that reality defines the present day. We are now in a leadership transition. Martina Cheung took over as CEO in late 2024.
And looking at the operational data from 2025 and the early moves in 2026, her tenure seems to represent steady continuity rather than some radical reinvention of the Peterson playbook.
The early execution under Cheung has been highly disciplined. She has continued the strategy of portfolio pruning. The absolute most significant move under her watch is the upcoming spinoff of the mobility division, which is planned to close in mid-2026.
Okay, I have to stop you there and play the skeptic, because this timeline from 2013 to 2026 is dizzying. They sell education. They buy S&L. They sell J.D. Power. They buy IHS Markit for $44 billion.
Yeah.
And then 4 years later, they're carving out and spinning off the mobility division they just acquired in that mega merger.
Right.
Is this actual visionary portfolio design, or is it just a messy, chaotic habit of empire building that they constantly have to clean up?
That is the exact debate happening on the buy side right now. The bulls argue that the leadership record earns respect because the decisions have mostly been proactive. They didn't sell J.D. Power or education because they were facing bankruptcy. They sold them from a position of strength to optimize the company toward higher value infrastructure.
The gardener pruning a tree.
Exactly.
Yeah.
They view it as a gardener aggressively pruning weak branches to let the strongest parts of the tree grow.
But the bears see a company that just can't stop buying things it doesn't need.
Exactly. The skeptical view demands that we dissect the extremely messy reality of this approach. Nearly every strategic leap has exponentially increased the complexity of the business. The recurring presence of continuous merger costs, massive severance packages, divestiture fees, and staggering amortization charges proves that while they might eventually reach the right strategic destinations, the journey they take is incredibly expensive for shareholders.
They absolutely do not travel light.
No, they don't. And this approach pushes a huge amount of the company's value creation directly into management's hands. When you grow through M&A, your returns depend entirely on management's ability to execute complex integrations and extract cost synergies, rather than relying on the natural, organic growth of your core toll booths. It introduces immense execution risk.
Let's focus on this upcoming mobility spinoff plan for mid-2026. Because to me, spinning off mobility feels like management quietly acknowledging that the automotive data asset, which was a huge selling point of the massive IHS Markit merger, just fundamentally didn't fit their core.
It is a tacit admission of exactly that. The mobility division is a very solid business on its own. It generated $1.75 billion in revenue in 2025. It tracks vehicle registrations, supply chain data, and automotive forecasts.
Which sounds great.
It does, but it did that at only a 22% operating margin. From an architectural standpoint, it is a valuable asset, but it dilutes the structural advantage of the ratings and indices core. It is not purely financial market infrastructure.
So if they're spinning off mobility today because it doesn't fit the high-margin core, what does this mean for the newer adjacencies they're aggressively building out right now? They're spending heavily to push into private markets data and artificial intelligence. Will those divisions eventually face the chopping block 10 years from now when a future CEO decides they're a margin drag?
It is a highly valid concern. The adjacent growth in private markets and AI remains partly acquisition-led and far less proven than their core moats. If those investments fail to produce durable, high-margin economics that rival the legacy businesses, history strongly suggests this management team will not hesitate to prune them later.
Right.
But again, that pruning process, carving out technology, separating sales teams, untangling corporate overhead, is highly expensive and incredibly distracting for the core business.
So management has actively curated this portfolio over 13 years. But every time they buy a new capability, they inherit immense financial baggage. We need to look at exactly what strengths and liabilities they're dragging into the modern post-mobility era as of May 2026.
Well, evaluating the balance sheet today reveals two massive, undeniable strengths. First, the trust-based franchise assets, ratings and indices. These are deeply structurally entrenched in the plumbing of the global financial system. They are irreplaceable.
Yep.
Second, they have a management team that has proven repeatedly that they are willing and able to reshape the portfolio when necessary. They aren't afraid to cut bait on a bad fit.
But the liabilities are just as glaring, and they sit right on the balance sheet. They're carrying a massive, acquired, intangible base. We are talking about $36.5 billion of goodwill sitting on their books at the end of 2025, along with another $16.3 billion of other intangible assets.
For listeners who might not look at balance sheets every day, we need to define how goodwill functions mechanically. Goodwill is an accounting term that essentially represents the premium a company pays when it acquires another business over and above the fair value of its hard, tangible net assets.
Okay, give me a simple example of how that works.
Imagine you buy a local bakery for $10 million. But when you look at the bakery's actual assets, the ovens, the display cases, the cash register, the flour in the back, it only adds up to $2 million.
Okay.
That remaining $8 million you paid is recorded on your balance sheet as goodwill. It represents the value of the bakery's brand, its loyal customer base, its secret recipes. It is the price of future expectations.
So when S&P Global has $36.5 billion in goodwill, it means they have paid a massive $36 billion premium for the growth they've acquired over the years, primarily from the S&L and IHS market deals.
Exactly. It represents a colossal amount of shareholder capital that has already left the building to pay previous owners. And the second structural liability is that business mix we discussed earlier. The high-growth adjacencies, specifically market intelligence, have fundamentally lower structural margins than the core.
So S&P Global is becoming cleaner by spinning off mobility and focusing on pure finance, but it is absolutely not becoming simpler.
No, it remains incredibly complex.
To visualize this, it feels like we are looking at a beautifully renovated house. The house itself, the ratings and indices businesses, is spectacular. The roof doesn't leak, the location is prime, the property taxes are low.
Right.
But to get the deed to the house, the market forces you to assume the previous contractor's massive high-interest credit card debt that funded all the messy renovations.
That is a very precise way to visualize the enterprise value. The operating assets are pristine, but the balance sheet reflects the heavy historical cost of all the renovations and additions over the last decade.
And how does the broader market misprice this dynamic?
Well, the market looks at the beautifully renovated house, sees the 70% margins in the core, and assumes the entire property functions with that same pristine economic efficiency. Investors often value the whole franchise as if the weaker, data-heavy end will magically converge upward. But the illusion breaks when you look at the true return on invested capital, or ROIC.
Let's do the math on that. If you calculate a simple trailing return on invested capital for 2025, it lands around the low teens, maybe 12 or 13%, which, on the surface, is good. It is comfortably above a normal corporate cost of capital.
It is acceptable. But you have to remember how that math is achieved. That reported ROIC is heavily burdened by the enormous denominator, the 36.5 billion acquired intangible base.
Ah,
The practical forensic interpretation of that low teens number is fascinating. The legacy, core franchises, ratings, and indices require almost no capital to run. Their individual ROIC is likely astronomical, potentially in the hundreds of percent.
but the acquired adjacencies market intelligence, the M&A premiums earn much, much lower returns on the massive capital deployed to buy them.
Precisely. When you blend the astronomical returns of the core with the mediocre returns of the acquired assets, the whole company looks like it generates a blended low teens return. The heavy acquisitions permanently drag down the blended efficiency of the whole enterprise.
Right. Knowing they carry this massive $36 billion anchor of goodwill forces us to ask how they actually service it. Where is the actual unadjusted cash coming from to keep this machinery moving? To see exactly how this drag impacts the bottom line today, we need to dive into the most recent 2025 and early 2026 financial realities. We need to look at their cash generation, their missing metrics, and their massive TAM projections.
Cash flow is always the ground truth because you cannot adjust it away. In 2025, S&P Global generated a phenomenal $5.65 billion in operating cash flow and $5.14 billion in free cash flow.
That is a mountain of cash. And they only recorded $195 million in capital expenditures for the entire year. Their cash conversion rate is top tier.
The ability to translate accounting earnings into hard cash is indisputable, but as we dissect where that cash actually originates, we have to return to the moats of the different segments. We already established that ratings has regulatory embedment and indices has the benchmark ETF flywheel.
But look at how management describes their own market intelligence division in their 2025 10K filing. Because they're legally required to disclose risks to investors. They explicitly describe the market intelligence landscape as intensely competitive, featuring both established, deep-pocketed firms and fast-evolving disruptors.
They acknowledge they are fighting a multi-front war for desktop real estate, and this leads us directly to a critical missing data point.
This is wild to me.
When evaluating a business with this much exposure to subscription software and data feeds, you look for specific sauce metrics. We scoured the sources, the investor presentations, the SEC filings. S&P Global does not disclose consolidated retention rates.
Yep.
They do not disclose customer acquisition costs or CACs. They do not provide a payback framework for how long it takes to break even on a new software client.
Which is highly unusual, if not outright suspicious, for a company leaning this heavily into a modern data and software narrative.
It is a glaring omission.
Especially when you look directly at their primary peers. MSCI reported a 93.4% retention rate in the fourth quarter of 2025. FactSet reported annual client retention of 91% for their fiscal 2025. They are proudly putting those retention numbers on page 1 of the slide deck.
And Moody's reported record 2025 revenue while maintaining an adjusted operating margin over 51%, proving their pricing power.
Exactly. So if I'm an analyst evaluating a software as a service or a recurring data business, retention is the holy grail. It tells me definitively if customers actually find the product indispensable or if they're just trying it out and churning. Why are peers like MSCI and FactSet proudly displaying their 90+% retention scores while S&P Global leaves that metric entirely out of the conversation? Are they hiding a massive strikeout rate in market intelligence?
A skeptical investor has no choice but to view this non-disclosure as a yellow flag. It doesn't definitively prove that their retention is disastrously poor, but it strongly suggests that management is carefully, tactically curating their metrics. They are intentionally emphasizing what flatters the narrative, such as top-line revenue growth and adjusted segment margins, while omitting the specific operational metrics that might reveal the fierce, grinding churn they face in the market intelligence trenches.
It is omission by design. They don't want analysts building models around their churn rate.
Exactly. And we see a very similar dynamic of framing when we look at how they project their future growth. Specifically, how they define their total addressable market, or TAM, versus their serviceable addressable market, or SAM.
Right. At their 2025 Investor Day, management was touting truly massive numbers to the street. They highlighted roughly $21 trillion in global private markets assets under management by 2029. They're leaning heavily on the narrative that they will capture massive revenue from the explosion in private credit and artificial intelligence opportunities.
The TAM, the total amount of money existing in the private market space, is indeed massive. But the monetizable SAM, the actual portion of that market that S&P Global can practically capture, service, and profit from, is likely a fraction of what the slide deck implies.
Contrast that speculative projection with the proven, Mathematical monetization of the indices segment. Indices finished 2025 with $5.48 trillion of actual real-world ETF assets linked directly to its benchmarks.
This is the difference between a narrative and a mechanism. The indices flywheel is a proven mechanism. The AUM grows, the fee is mathematically applied, the cash is collected, it is a toll booth.
Compare that proven mechanism to the unproven, highly speculative narratives surrounding artificial intelligence and private markets. AI is currently a powerful narrative in search of fully evidenced economics. We know it's a buzzword that excites the market. We know it requires massive upfront capital investment in compute and talent. But can S&P Global actually monetize their AI tools at a 60% margin?
It is highly unlikely. They will undoubtedly build great AI tools for their Capital IQ terminals, but so will Bloomberg, so will FactSet, and so will 100 well-funded startups. AI might simply become a table stakes requirement just to maintain your current clients in the market intelligence space, rather than a new magical toll booth that prints incremental free cash flow. It becomes a defensive capital expenditure, not an offensive margin expander.
So management is leaning heavily on these massive speculative narratives of AI growth, while simultaneously obscuring the fundamental retention metrics of the division tasked with building it. And this brings us to a much broader forensic concern about how this executive team communicates with stakeholders, how they align their incentives, and how they calculate their own success.
When a company relies this heavily on M&A and narrative framing, you must look closely at governance, executive incentives, and the specific accounting framing they use. Let's start by looking at the proxy vote, because it reveals exactly how the institutional owners feel about management.
This is a fascinating thread to pull. In 2025, the company's say-on-pay vote fell dramatically. It dropped to roughly 68.8% shareholder support.
We need to contextualize that number. A say-on-pay vote is a legally mandated, non-binding vote where shareholders express their approval or disapproval of the executive compensation packages. Generally, a healthy, respected management team will see support levels in the mid to high 90s.
Like 95, 96%.
Right. And the year prior, S&P Global had about 96% support. A sudden drop to 68% in the corporate governance world is the equivalent of the institutional shareholders, the BlackRocks and Vanguards of the world, standing up in the middle of the room and booing the board of directors.
And why did they boo? What triggered the revolt? Primarily, it was because investors strongly objected to a special, highly lucrative severance package granted to the former market intelligence president during the CEO transition process.
It signals a profound disconnect. Shareholders felt that the board was taking care of its own executives at the explicit expense of disciplined, shareholder-aligned capital allocation. But what is even more revealing for a skeptical investor is how the board responded to that rebuke.
You would think they would tighten their belts and apologize. But despite that massive drop in shareholder support, the 2026 proxy statement shows that long-term incentive targets were actually raised materially for several key executives. CEO Martina Cheung's target increased from 9.0 million to 14.5 million.
Now, to be fair, this doesn't cross the line into an outright governance failure or fraud, but it severely weakens the argument that this management team deserves unquestioned trust.
Yeah, the optics are terrible.
Pay decisions immediately following a violently weak say-on-pay result should have been visibly conservative if the board wanted to maximize credibility with skeptical owners. Instead, they doubled down.
And then there's the capital return policy, which also looks highly aggressive when you peek under the hood. From 2023 to 2025, they returned over $15 billion to shareholders, mostly through massive stock buybacks. In early 2026, they raised their target again, now expected to return 100% or more of their 2026 adjusted free cash flow.
Returning capital to shareholders is generally a positive signal, but context is everything in corporate finance. We have to look at how they're funding those buybacks. They are doing this while their commercial paper debt is actively rising.
Explain how commercial paper works in this context.
Commercial paper is a form of short-term, unsecured corporate debt. It's essentially a corporate IOU that matures in a few weeks or months, used to fund immediate short-term liabilities like payroll or inventory. Between the end of 2025 and March 2026, S&P Global's commercial paper balance rose from $715 million to $951 million.
Why is a $122 billion company using short-term unsecured debt to buy back its own stock? Buying back stock aggressively while taking on short-term debt, right in the middle of preparing a massive, incredibly complex spin-off of the mobility division, looks undisciplined. It looks like financial engineering to prop up the EPS number.
It introduces unnecessary duration risk. Using 30-day paper to fund permanent equity reduction is an aggressive maneuver. But the biggest forensic concern of all, the absolute centerpiece of the skeptical thesis, is their heavy, persistent reliance on non-GAAP metrics.
GAAP stands for Generally Accepted Accounting Principles. It is the strict, required, legally binding way to report corporate earnings. Non-GAAP, or adjusted earnings, is essentially management's way of saying, here is what our profits would look like in a perfect world if you just let us ignore certain costs that we consider one-time or non-core.
And S&P Global relies on their adjusted metrics more aggressively than almost anyone in their peer group.
It's extreme.
In 2025 alone, they excluded a staggering $1.07 billion in annual amortization costs from their adjusted earnings. They consistently exclude severance packages, legal costs, leadership transition costs, and they are already explicitly telling investors that their future 2026 guidance completely excludes the stranded costs from the upcoming mobility spinoff.
I want to dig into these stranded costs because it sounds like accounting magic. How does stranded costs actually work during a spinoff?
When a massive company spins off a division like mobility, they are carving a chunk out of the enterprise. That division takes its specific revenue and its direct engineers with it, but it leaves behind a portion of the vast corporate overhead that used to be shared across the entire larger company.
Like what?
The massive HR department, the sprawling IT infrastructure, the expensive corporate leases, those don't automatically shrink just because mobility left. Those leftover unsupported expenses are stranded costs.
So S&P Global's remaining core segments suddenly have to absorb all that extra overhead, which inherently crushes their operating margins. But management is essentially saying, hey, just ignore those costs when you evaluate our future profitability.
Exactly. They are asking you to value the company on a theoretical margin that doesn't include the friction of their own strategic decisions. And the exact same flawed logic applies to the $1.07 billion in amortization they exclude every single year.
This is the part that makes me genuinely furious as an analyst. If your entire overarching strategy for the last decade has been aggressively acquiring other companies to grow S&L, IHS market with intelligence, how can you justify systematically excluding the cost of those acquisitions from your core earnings?
You really can't.
It's like a serial home flipper asking you to ignore the cost of the mortgages when looking at their profits. Look how much money I made on this house if you just pretend I didn't have to pay the bank the principal.
The home flipper analogy is perfect. And to be absolutely clear, this is not an accounting fraud red flag.
No.
The external auditors signed off on the DAP numbers. It is perfectly legal.
Right, it's just framing.
Exactly.
Yeah.
The issue here is purely about analytical framing. For a serial acquirer like S&P Global, amortization is not some rare one-off non-core event like a natural disaster. It is the explicit toll they choose to pay for strategic breadth. It is a recurring fundamental cost of their chosen growth model.
But, if amortization is technically a non-cash paper charge depreciating an old asset, why shouldn't management ignore it? It doesn't affect the cash in the bank today, right?
It doesn't affect today's cash, but it represents massive economic reality. Software and data architectures rot. They decay. If you buy a cutting-edge data platform today for $1 billion, the code becomes obsolete in 5 years.
Right.
Amortization is the financial representation of that code rotting. If you ignore the amortization, like SPGI does to boost their adjusted EPS, you are pretending your software stays fresh and competitive forever without requiring massive reinvestment.
By persistently excluding it, they fundamentally understate how much capital is actually required to sustain their massive scale. They demand full credit from the market for the top-line revenue the acquisitions bring in, but they outright refuse to accept the penalty for the immense price they paid to acquire them.
If the macroeconomic environment hits a down cycle, if debt issuance freezes this heavy reliance on adjusted metrics, combined with the aggressive executive pay hikes and the weak say-on-pay vote, will erode investor trust very rapidly.
Oh, instantly.
When times are good, Wall Street happily ignores the adjustments and cheers the stock price. But when times get tough, those adjustments become the very first thing skeptical analysts attack.
So we've built a very clear, highly detailed view of the structural reality.
Yeah.
We see the business barbell, the messy decade of M&A, the missing retention metrics, the aggressive buybacks, and the heavily adjusted accounting. We finally have to ask the ultimate question for any investment memo. Is this stock worth buying at today's price of $410?
To answer that with intellectual honesty, we must look at the explicit structural risks on the horizon and compare them to the current valuation multiple.
Let's start with the risks, straight from their own 2025 10K filing. And this is not just generic boilerplate language drafted by lawyers. They specifically state that their massive investments in artificial intelligence may completely fail to gain market acceptance, or it may materially increase their cost profiles without driving revenue.
But the most crucial existential risk disclosure in the entire document is this specific admission. They admit AI could allow competitors to lower the cost of information collection and processing, which could structurally dilute the value of S&P Global's proprietary data.
Which is wild because the bull case being shouted on CNBC right now says AI makes S&P Global infinitely stronger because they possess the best, cleanest historical data to train the models.
That's the popular narrative.
But reading their own risk disclosures, could AI actually be the ultimate terminal threat to market intelligence?
Let's walk through the mechanics of that threat. Currently, how does S&P Global make money in market intelligence? A junior analyst at a major investment bank spends 40 hours manually reading dense corporate 10Ks, scraping tables to build a financial model.
Yeah, a lot of grunt work.
S&P Global sells a $20,000 a year terminal that aggregates that data, turning a 40-hour task into a 10-hour task. The bank happily pays the $20,000 for the efficiency.
Okay, that makes perfect sense.
But what happens if an open-source large language model can instantly scrape, synthesize, and format every global 10K, which are publicly available on the SEC's SPGI database anyway in 3 seconds, for a fraction of a cent?
The core value proposition of the $20,000 terminal instantly collapses. If the LLM does the heavy lifting, why pay a massive premium for S&P's proprietary workflow tools? The raw data loses its premium wrapper.
That is the exact existential threat. AI could completely reduce the scarcity of organization, synthesis, and delivery in the enterprise data stack. It threatens to commoditize the very thing market intelligence sells. This is precisely why the strongest, most defensible parts of the franchise remain ratings and indices. Those are businesses where trust, regulatory mandate, and massive network effects matter far more than raw data aggregation. You absolutely cannot ask an open-source language model to issue an official, legally binding, regulatory-approved credit rating for a billion-dollar bond.
No, the SEC would never allow that. So, we have a genuine structural existential threat to their largest revenue segment. Now let's look at the price tag the market is demanding we pay to assume that risk. On May 19, 2026, the stock is trading at roughly 26 times trailing GAAP earnings.
And if we use the midpoint of management's 2026 adjusted EPS guidance, which they project to be $19.52, the stock is trading at roughly 21 times forward adjusted earnings.
How does that 21x forward multiple compare to their direct peers?
It presents a very mixed, complicated picture. Moody's is trading much higher, commanding roughly 31.2 times trailing earnings. MSCI is trading at a rich 33 times. But FactSet is much cheaper, trading down at 14.3 times.
So a lazy bull might look at a basic screener and say, look, SPGI is trading at 21x, which is vastly cheaper than Moody's at 31x. It is a massive bargain relative to its peers.
And that would be a deeply flawed, highly superficial buy thesis. S&P Global is cheaper than Moody's for a very specific structural reason. It has significantly higher exposure to the lower margin data businesses of market intelligence. It faces vastly more direct AI disruption risk, and it is right in the middle of a messy, expensive portfolio transition with the mobility spinoff.
Right.
Relative cheapness to a fundamentally richer, purer peer does not automatically make a stock a buy.
The correct question to ask isn't whether it's cheaper than Moody's. The right question is whether this specific, messy set of risks deserves a 21x forward multiple on heavily adjusted earnings that ignore $1 billion in amortization.
And under a strict, skeptical, buy-side analytical framework, the answer is no. This investment only works if a long series of highly optimistic assumptions all hold true simultaneously.
Let's list those assumptions out to see how fragile the thesis is. You need global credit issuance to remain perfectly supportive, to fuel the ratings transaction revenue.
Yeah.
You need global equity markets to keep going up indefinitely to support the indices AUM flywheel. You need market intelligence to somehow successfully monetize AI at high margins before AI commoditizes their underlying data.
Right.
You need the mobility spinoff to close cleanly without massive, lingering, stranded costs destroying the operating margins. And you need a management team that just got rebuked by a 68% proxy vote to maintain strict capital discipline.
If even one of those structural assumptions falters, the current valuation is severely stretched. Consider what we call the plausible disappointment scenario.
Walk me through exactly what that looks like.
The company does not have to structurally fail or go bankrupt for the stock to severely underperform the market. Imagine just a mild, normal, cyclical slowdown in corporate debt issuance due to sticky inflation.
Okay, totally plausible.
Combine that with a flat, sideways year in the S&P 500, meaning indices revenue stalls out. Add in slower than expected AI monetization and higher than expected stranded costs from the complex mobility carve-out.
Under that totally plausible scenario, the company is still highly profitable. It is still a massive financial giant generating cash. But the seamless growth story completely cracks. The narrative fails. The market multiple compresses rapidly from 21x down to 15x, and the stock price drops 30%, while the underlying business only slowed down by 5%.
Exactly. Paying a premium multiple for heavily adjusted earnings during a massive corporate transition leaves absolutely zero margin of safety for the investor.
Okay, let's consolidate all of these extensive deep dive findings into the bottom line for you listening. If you are building an investment memo based on this deep dive, you need three key takeaways.
First is the barbell reality. S&P Global is an undeniably incredible business at its core. Ratings and indices are exceptional, structurally embedded toll booths. But that pristine core is permanently dragged down by the much larger, lower margin, and intensely competitive reality of the market intelligence segment.
Second is the non-GAAP illusion. The company's heavy, persistent reliance on adjusted metrics obscures the true, highly capital-intensive nature of their massive, acquisition-driven growth strategy. They demand credit for the scale the acquisitions bring without accounting for the billions in real economic amortization required to maintain that scale.
And third is the transition risk. The current valuation multiple simply leaves no room for error. Investors are being asked to pay full premium price while the company navigates the complex mobility spinoff, absorbs margin-crushing stranded costs, and attempts to prove that its massive AI investments will actually generate durable, defensible profits against a wave of commoditization.
Which leads us to a final provocative thought for you to mull over as you close your notebook today. If artificial intelligence really does advance to the point where it completely commoditizes basic financial data aggregation over the next decade,
It's a real possibility.
right, will S&P Global be forced to retreat entirely to its regulatory, legally mandated toll booths of ratings and indices?
And if they do eventually have to retreat and abandon the data wars, what exactly happens to that $36.5 billion in goodwill sitting on their balance sheet today? Because if the data business gets commoditized, that massive goodwill will face a historic impairment charge, wiping out billions in paper equity overnight.
It brings us right back to the beginning of the property tour. We came looking for a clean structural x-ray of a highly profitable financial compounder. But instead, we found a highly complex, heavily adjusted diagnostic picture of a barbell business. It is a great business, undoubtedly, but at this price and with these specific structural risks, the waters are just too muddy to jump in today. Thank you for joining us on this deep dive into the source material. Remember, true financial insight always requires looking past the adjusted numbers to see the bones underneath.